This is the Asia Trade. I'm Shery in Tokyo.
I'm Haidi, Stroud-Watts in Sydney. The top stories this hour. Treasury yields tumble and the yen gains as data showing a US labour market slowdown backs the case for supersized Fed rate cuts. Asian stocks are set to track Wall Street losses. US Steel among the biggest losers on reports that President Biden is preparing to block Nippon Steel's $14 billion takeover. And Nvidia's slump extending to 15% since last week's earnings report as it denies being subpoenaed by the Justice Department. Firmly focused on eco, and we get South Korea's GDP numbers just crossing the Bloomberg now. And we are seeing, when it comes to that year-on-year number, the second quarter preliminary reading coming in at 2.3%. That is bang in line with expectations of 2.3% and also unchanged from the previous reading of 2.3% there as well. So that estimate remaining the same. Quarter on quarter, we're seeing that contraction of 0.2% again, in line with estimates and also unchanged from the previous reading there as well. So not much of a surprise when it comes to these GDP numbers for the second quarter, but of course we have seen some sort of concerns over elevated inflation in South Korea. We've heard from the Bank of Korea governor most recently saying it is time to sort of potentially mull that policy pivot, Shery.
Especially given that we have seen the resilience in the South Korean economy, export really returning to double-digit growth already last month. But when it comes to the markets, the Kospi really saw the worst day since the August 5th meltdown. We will be watching how they open, but this is the setup across Asia because it was a similar picture for other Asian indices. The Nikkei, for example, falling more than 4% yesterday. Right now, we're seeing downside and pressure on Nikkei futures at the moment. Of course, we had the Japanese yen spiking overnight more than 1% at one point against the U.S. dollar, really on expectations of Fed rate cuts. Take a look at how we're setting up with U.S. futures because we have seen stocks marginally lower in the overnight session, but really the action was in the bond space. And this is, of course, because U.S. job openings fell to the lowest level since 2021. So you had this huge reaction in the bond space, Treasury yields falling across the curve. We're talking about the 2-year yield briefly dipping below the 10-year yield. So that key part of the yield curve really disinverting, showing people's concerns about a potential recession. Bond volatility at the highest level in more than a year. We're seeing a little bit of a mixed picture. Of course, we had Nvidia also losing ground in the overnight session and continuing that sell-off. Oil also, given the concerns about the economy now at the lowest level in more than a year, Heidi.
Shery, and what a pretty terrible month when it comes to stocks. Let's bring in our Bloomberg opinion columnist and senior editor for markets, John Authers. John, you said wake me up when September ends, but we've insisted that you join us now to talk about this horrible month that's really just gotten started. Do you think the trends are sort of worth noting, the sort of historic terribleness for risk assets for September, or are we talking about more of a kind of idiosyncratic sell-off at the moment?
Both. Plainly, the fact that September shows up being so bad in history is because the Lehman bankruptcy happened in September and the 9/11 terrorist attacks happened in September. If you take those out of the equation, September still comes across as a seasonally poor month, but it's nothing like as shocking as it otherwise would be. I think what really matters at this point, and the reason why we have had a recurrence of really major angst at the beginning of a month, is labor market. We get US labor market data at the beginning of every month. Last month, you got fairly worrying ISM numbers and then a very surprisingly poor US payroll number. And that was what helped that very big sell-off we had then. This time around, again, we've had disappointing employment numbers. The Fed has told us that it's employment that matters more than anything else. We have non-farm payrolls coming on Friday. That's basically going to be when we find out whether there will be a 25 or a 50 basis points cut later this month. But that now looms as being very big. For the time being, people are nervous and taking excuses to sell rather than reasons to buy.
In that sense, would that just be a lose-lose situation? Doesn't matter if you beat or you miss estimates, you would still get market volatility.
Yes, this is a very volatile situation. My best guess, if you take a look at the amount of easing that is currently priced in, we're expecting 9 cuts over the next 9 Fed meetings. Effectively, that's a big, drastic easing. And I looked at research from SocGen, go all the way back to 1990. The markets haven't been pricing in that much easing on the eve of the first cut before. That's a very, very aggressive expectation. Similarly, if you take a look at where the 2-year yield is at the moment, very much dependent on where you think rates are going to go over the next 2 years compared to Fed funds. It hasn't been this far below the 2-year, i.e. that yield curve hasn't been this inverted since the very beginning of 2008, which is basically when the markets could see really serious trouble coming before the Fed did and accurately predicted the Fed was just going to have to slash rates. I hope that this is an overreaction. I think there is probably more of a risk that people realize they've overdone it again, like they did last month, and that we'll see a rebound. Plainly, if it's a really poor non-farm payroll number, then that's going to be a very exciting and not particularly pleasant day come Friday.
Yeah, the countdown is on. Bloomberg opinion columnist and senior editor for markets, John Authers, great to have you with us from New York. And our next guest says she's not seeing signs of an imminent recession in the U.S. Joining us now is Sylvia Jablonski, CEO and CIO at Defiance ETFs. Sylvia, great to have you with us. Of course, we're seeing the risks of recession in the markets, especially when it comes to that yield curve disinversion. But what are you seeing on the ground when it comes to that economic data, how households are doing, how the service sector is doing in the U.S.?
Good evening. I think that this week spooked markets a little bit, right? It's been a rough start to a September, one of the worst ones we've seen in decades, really, for S&P and NASDAQ. And so right away, you kind of hear a lot of investors jumping to the idea that, we're in a recession. We had this carry trade fall apart. We had a couple of, weak job number, ISM manufacturing. But if we take a step back, we're still in a pretty good spot, right? The S&P 500 is pretty much done with earnings. We have a handful coming up, but 90% of the names had 10% year-over-year growth in EPS. You saw a broadening of performance in equities across the earnings season as well. The economy is growing 2 to 3%. Jobs numbers are still pretty stable. I mean, if the rate moves a little bit, it's still, well below 5%. And staying stable. Households are spending, continue to spend and seeing, wage growth. And I think all in all, it feels like that soft landing is in play. It's September, that volatility comes into play. You get a couple of weak readings, but what's coming around the bend is the Fed cutting.
Does that mean that you're just trying to ride out the potential make or break payrolls numbers? And how are you positioning?
Yeah, I'm definitely not riding it out. When I see the market pull back as much as it did on a day like Monday, and we talk about this a lot on your show, but I'm very bullish on the future of AI and tech and things like this. And when I see names like Nvidia, regardless of kind of the outside noise of what's going on around earnings not being as stellar, it was a solid beat. And I think that that's the future. Innovation is the future. And so these names pulling back, for me, are buy on the dip opportunities. I'm always looking to pick up stocks when the market falls the way it did on Monday. And I think, today, tomorrow, the next day, I'll kind of ride it out and see where the jobs number takes me. But if we get another pullback on Friday, I'll probably be another buy. I'll probably have another day where I'm buying on the dips, particularly in some of the semiconductor and tech names that I like.
Yeah, tell me about the opportunities that you see where, post this sell-off, things might be looking a little bit more attractive from a valuations point of view.
Yeah, for sure. And I think, another great point too is when we look at historically years like we've had so far, and we see the kind of run up that we had into these pullbacks, oftentimes the end result is an S&P and, broad-based NASDAQ performance up to the tune of 15 to 20% afterwards. So the market can certainly end up higher, right? This is a pullback. I like that, I like the names that, we talked about a little bit. I like MicroStrategy, both Bitcoin and semiconductors are pulling back. The AI trade has pulled back a little bit. I like Broadcom. That's going to announce earnings. That's a company. They're really the intelligent chip. They're kind of number two in terms of demand as compared to Nvidia for the future of like AI, tech connectivity. They're involved in wireless communications, data centers, all of these areas of the market that are growing. And their biggest clients are the Mag 7 companies like Microsoft and Amazon and Google and things like this. So I really like that name. They're about to report. We'll be looking to pick up some position there. They've had a 40% run, but pulled back a little bit recently. And then, the $1 million healthcare baby, Eli Lilly, you have Mounjaro, you have Zepbound, you have weight loss drugs. Markets like this, right? What do we care about? We care about defensive stocks that pay nice dividends and have strong balance sheets. And, that coupled with the momentum that they have on their menu of drugs, it's a name that I'll look to pick up as well.
What is your time frame when it comes to holding patience for the AI story, right? Because there were a couple of interesting remarks in the wake of the Nvidia sell-off saying that, you really need to start seeing companies outside of AI start to invest and that demand for services to meaningfully increase. That this is going to be, a multi-year, potentially multi-decade sort of story. So I'm wondering what your framework might be for that.
So I think like anything else, right? We get the hype of a new theme and a new idea, and that's, the ChatGPT moment in AI kind of came out to the market, and then, all of the stocks kind of run up, and then, expectations are tempered when you get these, massive pullbacks, and then I think we all kind of become a little bit more reasonable and think, to your point, this is going to take a little bit of time to play out. You saw what happened with Microsoft today, right? They need to work out the kinks with Copilot. Nvidia had their issues with the Blackwell chip. They didn't have enough supply for the demand, but I think so. Nvidia in the short term, I think, is going to hit new highs, right? I think the Blackwell chip just actually getting out to the market is going to pay off in the next earnings announcement and the one after that. But then after that, maybe we have more slow and reasonable growth. But I still think there will be growth. I still think there'll be double-digit performance in a lot of these names. But to answer your question, there are some stocks that I hold forever and buy on dips, and those stocks are often names like Apple, Microsoft, and Nvidia. I mean, these are lifer holdings for me, right? And I like pullbacks on these names.
Sylvia, always great to chat with you. Sylvia Jablonski, CEO and CIO at Defiance ETFs. Coming up on the Asia trade, OPEC Plus close to an agreement on delaying a plan to increase in crude production. We get more on what we're seeing across crude markets. Vanda Insights will be along with us shortly. Also hear why Macquarie Wealth Management expects increased market volatility but remains strategically positive for 2025. And as the forum on China-Africa cooperation gets underway in Beijing, we take a closer look at China-Africa relations with the University of Notre Dame. This is Bloomberg.
Nvidia extending its two-day sell-off to 11%. We're talking about a slump that's really brought down all of the AI market darlings, including chip makers. Nvidia, though, saying it's not been subpoenaed by the DOJ. That was as part of a report of an antitrust probe. Also, U.S. Steel down more than 17% in the U.S. close, and this is the worst day for the company since April of 2017. President Biden said to be preparing to block Nippon Steel's $14 billion takeover of U.S. Steel. Sources say a decision could come as soon as this week. For more, let's bring in Bloomberg Simon Casey. Simon, so this is, of course, an election year, and really this deal at the center of a firestorm. What are we hearing?
Well, I mean, as we've reported today, Biden is basically, the deal is dead, effectively. He has decided, we've been told, that he is going to block the deal. What we're waiting for, what he is waiting for, is the Committee on Foreign Investment in the U.S., CFIUS, which is a secretive National Security Focus Committee to come out finally with its recommendation. But it appears, irrespective of its recommendation, he's going to block the deal. And as he has stated numerous times this year, he wants US Steel to remain an American company, American-controlled, and that is ultimately why he is blocking it. His political rival, Donald Trump, and Kamala Harris, no less, came out on Monday as well, said the same thing. So there is political unity here. The Steelworkers Union, the very powerful union here that has many workers at US Steel, has also been opposing the deal right from the start.
US Steel has said they stand by the fact that there are no national security issues associated with this transaction. They're going to pursue all legal remedies that might be possible. What sort of avenues of relief might be here? Well,
I'm no lawyer, but I think if President Biden issues a decree that this deal will not go ahead, it's effectively dead. And you can see from the stock price, I mean, it's trading way, way below the offer now, back to below, I think, where it was at the start of this whole process back in December. So the market has moved on. And it's a bitter pill for the current management of US Steel. They don't have many paths forward. They've warned overnight that there could be big job losses if this deal doesn't go ahead. They badly need the kind of outside investment that Nippon Steel would have offered.
Bloomberg Managing Editor for Energy and Commodities, Simon Casey, there with the latest. Taking a look at one of the other stories that we're tracking, and US Democratic presidential nominee Kamala Harris is calling for a 28% capital gains tax rate on people earning $1 million or more. She says a hike from the current 20% would ensure the wealthy pay their fair share. The new detail on her economic plans comes as Harris seeks to draw a contrast with Republican rival Donald Trump.
If you earn $1 million a year or more, the tax rate on your long-term capital gains will be 28% under my plan, because we know when the government encourages investment, it leads to broad-based economic growth and it creates jobs, which makes our economy stronger.
More ahead on the Asia trade. This is Bloomberg.
Nvidia shares continued their post-earnings slide, with traders now watching the $100 level. The company, meanwhile, has responded to a Bloomberg report on a U.S. antitrust investigation by saying it's been in contact with the DOJ but's not been subpoenaed. Tech reporter Annabelle Drewlers joins us now from Taipei. Belle, what exactly are they saying?
Well, they're saying similar to what we'd already been reporting on Bloomberg, but it really is that the company is saying that, yes, if there is any sort of dominance at Nvidia of its products, it's because the products speak for themselves and the quality that you get from an Nvidia chip. So this is all part of this ongoing investigation by the DOJ, and what we had been reporting at Bloomberg was that they had subpoenaed Nvidia and other companies. But regardless, it does seem that there is a lot of scrutiny on Nvidia itself and whether it's sort of created a monopoly structure where it's making it difficult for others to compete in the space and difficult for its customers as well if they're looking for non-Nvidia suppliers. The stock price itself, because on the last session we continued to see it sort of trading a little bit sideways, ultimately it closed around the $105 mark. As you were saying there, yes, it does seem that $100 a stock could be sort of the bottom line in the near term. Certainly, though, when you speak to analysts in the market, they're saying the fundamentals have very much changed around Nvidia possibly.
And of course, what a day to be, at the Semicon event yesterday, right? It's sort of in the wake of this big sell-off and all of these concerns. What's sort of some of the commentary that you were hearing from the people that you spoke to?
Yeah, well, we've been speaking with people across the week here in Taipei, and certainly even ahead of that Nvidia, we still had the results out and questioning people whether they saw any sort of weakness in their products and their sort of orders. But certainly at a high level or an aggregate, people are very optimistic here on the ground. And one of those companies I've been speaking to is Scientech. Now, Scientech is a stock that has performed very well on the Taiwan Stock Exchange this year. It's actually one of the best performers in the sub-index for semiconductors. And what it does is well, a few different things, but provides a technology that enables advanced packaging to take place. Advanced packaging is taking on an increasing role in the chip space. But here's my interview with the CEO earlier. Take a listen.
We are lucky in this AI industry. We benefit from the equipment that we build, the process that we develop with customer together to enable AI process. So that's why our investors value Scientech as a potential company who can really contribute in this industry.
And what sort of demand are you seeing? What's your outlook for demand for your equipment toward the end of this year, but next year as well?
The growth will be substantial for next few years. The growth rate will be much, much higher than 8%.
Can you give the number?
The equipment that we sold to them probably increase 2 or 3 times a year. It is possible. And so it is also benefit Scientech from their revenue.
Do you see any risks to that outlook?
From my personal perspective, this booming of AI industry just begin. There's a lot of application I do expect will coming out pretty soon. So that's why Jensen Huang, some time ago, he said the overall market of AI will reach 100 trillion at some point in the next probably few years.
We're seeing a lot of Taiwanese companies that are choosing to expand abroad. Do you see any sort of concentration risk from choosing to focus your attentions here?
Of course. Definitely, we will try to, evaluate alternative locations, either for the R&D, for the manufacturing. Internally, this is under our processing.
Speaking more broadly now, what has been really capturing a lot of attention in the chip equipment manufacturer space or chip equipment provider space is the measures that we're seeing applied on Tokyo Electron and ASML and restricting sales of certain equipment to mainland China. That risk of tariffs or being prevented from selling to the Chinese market, is that something that concerns you or Scientech as a business?
My direct answer to you is no, because the equipment that we built mainly for packaging applications, and the packaging applications is not included in this limitation.
Do you see that risk ever appearing in the future? Is it something that you're looking at closely?
We all know the advanced packaging is becoming more critical every day. Most likely it will happen, but who knows?
Really great conversation with the Scientech CEO, but that focus, that last point on geopolitical tension, something close to a lot of different executives here.
Tech reporter Annabelle Drillers there in Taipei. More ahead on the Asia trade. This is Bloomberg.
We have breaking news out of Japan. We have labor cash earnings year-on-year growth of 3.6% for the month of July, beating economists' expectations, but a little bit of a slowdown from the previous month. But remember, the previous month we had that extra temporary boost because of the spring labor talks, the Shunto negotiations. The real cash earnings year-on-year is what we're watching for. The wage growth accounting for inflation. Staying in positive territory, 0.4% growth. The expectation was for a contraction of 0.6%. 6%, still slowing a little bit from the previous month. Our Japan government and economy reporter Erika Yokoyama joins me now here in the studio. So it's a beat on expectations, but a little bit of a slowdown from the previous month. So how positive should we assess these numbers?
I think it's actually quite positive, and this is another indication that virtual economic cycle is spinning in Japan. And, you know, the real wage figure is pretty strong, and what's stronger is something called same sample data, which excludes bonuses and avoid sampling issues. Then that showed a record 3% hike for regular workers after reflecting the strong pay gain that the Japanese workers saw earlier this year. Then I think this will keep feeding into consumption. Actually, there are already some signs of improvement in consumer sentiment, as we saw in the GDP figure last month, consumption turning positive for the first time in 5 quarters.
So are we then sort of assured another rate hike from the BOJ?
Well, I think it will keep the door open for the BOJ to consider another rate hike. You know, Ueda said that, repeatedly said recently that he would consider another tightening step if economy and prices are moving in line with the projection. Then the economic indicator so far, like after the July rate hike, actually points to the direction in line with the BOJ seeing. So yeah, and most economists are seeing some movements sometime between October and January. And I guess the strong economic condition, including today's data, will probably make their projection quite likely scenario.
I mean, given the expectations now from the markets about the BOJ, we continue to see the Japanese yen strengthening against the US dollar. Of course, we had that 1% plus gain overnight. That was a function of what was happening in the US economy. Right now, the Japanese yen actually breaking through that 144 level against the US dollar. But again, I guess, given what you've told us about consumption, about the strength of the Japanese economy, given these numbers, this should be positive for the LDP presidential elections, the sort of economic outlook when it comes to Prime Minister Kishida?
Exactly. So yeah, Japan is expecting to have LDP is expecting a leadership election in the end of the September, and right, this strong economic condition will be a tailwind for LDP as the candidates start the campaign. And also after that leadership election, Japan is expecting the general elections. Then LDP can just call for the continuity. But, you know, wage issues will remain quite important issues, whoever the next leader is. As, you know, the Prime Minister Kishida partly failed to achieve the wages gain outpaces inflation, then that partly caused dissatisfaction among voters, then lower the supporting rate. So I think, yeah, the next leader has to be really mindful how to handle these wage issues.
Our Japan economy and government reporter Erika Yokoyama here dissecting those wage numbers, Haidi, and of course, really a little bit of a different picture unfolding here in Japan, especially given the concerns about global demand.
Yeah, I was just going to say, Erika spoke about the signs of that virtuous growth cycle. Not much virtuous when it comes to the growth cycle for commodities demand at the moment. Shery, take a look at what we're watching. Of course, recent weakness in a lot of these industrial metals, iron ore, have really been quite concerning given the sort of continued decline in demand we see out of major markets like China. At the moment, we're seeing Singapore-traded iron ore futures up by just about 0.6%, holding well above that $90 a level, but we have been sinking pretty close to the lowest since about 2002. That weakness out of Chinese steel mills with the weak demand, the soft prices, the falling profitability continuing to weigh. New York crude trading just under $70 a barrel at the moment, pausing near that December low. US stockpiles falling, that sort of slightly balancing out the supply and demand picture there. Let's bring our next guest, Vandana Hari, who's a founder at Vanda Insights. Vandana, always great to have you with us. It feels at this point, given the global demand concerns, that even the signs of an OPEC plus pause may not be able to support this market.
Good morning, Heidi. It does look like that. We had some signals from OPEC plus members, unofficially, of course, yesterday, that they may consider pausing the planned output increase, but we didn't really see. Of course, that gave a bit of a support to prices, but not much, as you say. Look, OPEC will be fighting an uphill battle, even if it agrees to defer the tapering. But I do feel that that is still the minimum OPEC Plus will have to do. It will be a painful decision, no doubt, if they pause the tapering. These are very lopsided cuts. Only 8 members have been shouldering that burden. But on the other side of that balance, you have credibility. So we had OPEC Plus senior leaders back in June. After their decision sent prices tumbling, they said that we stand ready. If market conditions are not right for the additional supply, we stand ready to reverse even or pause the cuts. So I think one way or another, it is, and prices are coming close to that, what I would think is the tipping point for OPEC. They would want to defend a floor around, say, let's say $70 for Brent. So they can't keep quiet for much longer.
You talk about the bare minimum of the OPEC Plus has to do. What's the bare minimum that you think markets are expecting from the Fed? Because commodity markets, oil markets are just as nervous about these non-farm payrolls as the rest of the investment community.
Absolutely. So, in fact, I don't think we do see headlines that prices have been under pressure because Libyan supply is probably not as disrupted as it was, or we see headlines that because OPEC Plus is adding more, is poised to add more supply. But really, what has been hammering crude prices down, and especially so this week's plunge, has been the sentiment of the broader financial markets, and specifically with regard to U.S. recession and recession fears. So yes, what the Fed is going to do, and even ahead of that, I think investors are getting very jittery, even with an eye on U.S. macroeconomic data, as we've seen this week, right? So on Tuesday, weak manufacturing PMI numbers, I believe those were the main culprit in the sell-off, of course, across risk assets, but in crude as well. Again, yesterday, July job openings data wasn't very good. And it does look like investors are positioning for a weak print for August jobs data on Friday as well. The fear, of course, with regards to Fed, the pivot is baked in, right, at the meeting in 2 weeks' time. But the fear in the market is, will the Fed do enough? Will the pace of tapering of the Fed be enough to avert a sharp economic slowdown in the U.S.? And, that could continue to rattle markets and impact crude definitely in the 2 weeks from now, but potentially even after the Fed meeting.
Vandana, talking about financial markets and just the movements broadly on momentum trading, we've actually seen those algorithmic led traders turning increasingly bearish when it comes to oil prices. How much of that trend following is affecting just pricing?
Yes, so the algorithmic trading, commodity trading advisor, CTA, taking a major position and having a big sway on the markets, I think that is the reality of oil markets now going forward. So again, I would say there is going to be an underlying major factor for flux in the market with regards to what the Fed is going to do and what the implication for the U.S. economy, and so brace for more volatility in crude as well, because this algorithmic trading that you're referring to does amplify moves to the downside as well to the upside.
When you see divergence in economic outlooks, like you have the pressure on China, but then as we just spoke about, perhaps a virtual cycle taking hold in the Japanese economy, how does that affect oil flows and where those where the sources of oil towards Asia come from?
So when market participants try to assess the demand picture, China is obviously, a major factor. Now, the softness or the sluggishness in Chinese economy is not a huge surprise. Yes, their PMI manufacturing print was also in contraction, at least the official data, and that put some added bearish pressure to crude prices. But as far as the oil market and Chinese oil demand is concerned, I think it's pretty much baked in now that it is China is going to struggle to inject momentum into its economy. And, the data for the first 7 months of the year, at least, Chinese crude imports were down 4% year on year, which is quite something, considering China's very healthy demand, even through COVID and in the initial post-COVID rebound. But even when you look at demand globally, there isn't much to support sentiment right now, because U.S. demand is also sort of flatlining compared with a year ago, maybe slightly better, but at least 1 million barrels per day below where it was in 2019. European demand is not doing well. Diesel is under great pressure. Again, it's like synchronous manufacturing slowdown across US, Europe, and China. So the demand picture all in, and especially focused on the China weakness, is not very bright at this moment, not just for the remainder of this year, but even going into 2025.
Vandana Hari, always good to get your insights. Founder at Vanda Insights. Coming up next, we'll look at how South Korea's music and drama exports are giving its homegrown food and beauty industries a massive new platform to reach global consumers. This is Bloomberg. South Korea's economy shrank as initially expected. We're talking a 0.2% contraction from the previous quarter. From a year earlier, the economy expanded 2.3%. Perhaps one aspect to be encouraged about when it comes to South Korean policymakers could be perhaps the rising popularity of South Korea's entertainment exports. It's really given its homegrown food and beauty industries a massive new platform to reach global consumers. But despite Korean music, TV, and films pulling massive audiences, the government admits more investment is needed to cement the country's status as a global cultural powerhouse. Hallyu, or the Korean wave, has been around for more than 2 decades, driven by the surging popularity of K-dramas and K-pop. In recent years, the so-called K-content industry has grown into a multi-billion-dollar market, including everything from Korean cosmetics and video games to food and movies.
한국에 대한 궁금증?
I think people keep connecting with Korea, whether they want to learn to speak Korean or maybe even come to visit. All of this is the power of culture. It doesn't show directly, but it's seeping through.
This growing soft power has been turbocharged by social media, amplifying the reach of Korean superstars and brands around the world. The Bibigo brand has established itself at the forefront of Korean food around the world. But with the rising popularity of Korean dishes, a more saturated market is driving CJ Foods towards new and innovative ways to attract even the most refined palates.
I see a really exciting cycle, a virtuous cycle, where you get great content, you get great experiences, you get great food, which gets amplified through social media, and that just keeps multiplying. So I see that cycle. As long as we can continue that, I think the wave is here to stay.
Still, compared to Japan, another Asian cultural giant, Korea's output is relatively small. Japan's animation business, for example, is worth more than $20 billion compared to Korea's webtoon industry, worth just about a tenth of that. Seoul has now set aside a record budget this year to nurture the country's key cultural exports in the hopes of matching its own standing as a tech powerhouse.
We know that we need to invest in culture, but we are cautious about it because it doesn't produce fast results. So I think we invest a lot, but I still think it's not enough. We need to do more. Korean food giant CJ Cheiljedang is aiming to double its business within the next decade, betting on higher global demand for its Bibigo brand of dumplings, kimchi, and ready-made K-street snacks. CJ Foods CEO Minsok Pak spoke to us exclusively in Seoul about their global strategy.
We're expanding overseas, definitely in new markets, but it also is anchored off of products like mandu, our dumpling products. We have 7 categories that we've identified as globally strategic products for us. And if you look at something like mandu, right, we're able to take this product and localize it for consumers in the US, for consumers in other markets. There's the convenience that comes from this. You know, for example, this product is microwavable. Right?
Yeah.
So it's a simple tear open, and it's just 2.5 minutes in the microwave. And so it's a really easy process. We've got some of our others that can be pan fried, and then air frying is a great way of cooking up the products as well.
And the thing that I've realized is that you're really trying to appeal to new markets. I've even seen plant-based dumplings as well, which is not common in Korean foods, right? It's usually dumplings are meat and vegetables.
So plant-based dumplings, and this uses some of our proprietary technology that we have in plant-based meats, and they're really popular and growing in popularity in markets like in Europe. And then there are certain segments in the US where there's still quite a bit of interest in plant-based options. So while it may not be a core of our portfolio, right, we do think that there's quite a bit of an opportunity for us to continue to innovate with plant-based options. And then when you go to, for example, in the US, the interest in the localizing our flavors, right, we realize that chives, as an example, meat, beef and chives may not appeal to the local taste, but chicken and cilantro works quite well. And so we were able to localize the product using our core technology and our R&D capabilities in dumplings.
Does that also mean producing locally as well?
We do produce locally, and over time, as we build scale, we invest in local infrastructure. So like in the US, we've got local manufacturing there. We have manufacturing in Southeast Asia. We have Europe. Our manufacturing facility is in Germany, so it serves all of Europe that way. So we do invest in local R&D as well as local manufacturing so that we can tailor the products for those local markets.
How do you view the domestic market as opposed to your aggressive expansion overseas? Is it a calculation of where the future is for CJ Foods?
So the domestic market is a critical market for us. This is our home, right? This is roughly half of our business, and this is the source of a lot of the innovations. This is where the products come from. This is where a lot of our capabilities in R&D and manufacturing, et cetera. So this is an important market for us. It's a market where in most of our categories, we're either number one or close number two. So we have to keep this market vibrant, and we have to keep growing, and we have to stay successful in the market. But if I look at future growth and the global interest in Korean cuisine and Korean culture, it is coming from Europe, it's coming from the States, it's coming from Southeast Asia, it's growing in Latin America. So we've looked at the globe, and we've prioritized all the different countries and markets, and we have a list of the markets where we want to enter. And for us, Europe is an emerging market, as an example. Everyone else thinks about Southeast Asia or Latin America, but for me, Europe. Europe is a huge market opportunity for us, and it's one where we've been in Europe for a few years now, and we're growing 50% plus a year. And so there's a huge opportunity for us there. Korea has to stay as an anchor, really driving the innovation and our capabilities, but future growth really will come from outside of Korea.
Where does China fall into that mix of regions?
In Asia, China is an important market for us. It's a huge consumer market, particularly in food, and we have a very vibrant business there. We have local manufacturing, we have business in sauce, we have business in dumplings. We have some really exciting innovations that we actually launched in China last year with our new pasta lines there. So China is an important market for us, and I see definitely future growth opportunity in China.
When we talk about China, we tend to focus on the slowing economy, domestic demand being weak. Does that affect your business?
It does to a certain extent, right? Anytime when you have slowing domestic consumption, obviously as a packaged food player, it does impact you. But we happen to be in categories where household penetration is still relatively low, and there's a lot of excitement for the products and for the categories, and so we'll continue to grow that way.
When it comes to consumers, it's all about inflation as well and food costs rising. How is that affecting your business model?
I think it's impacted us just like it has all other food players. The commodity inflation in everything from grains to meats, the supply chain disruptions that happened in the last 24 months. It impacted us like it did everybody else. And so in many of our markets, we did have to take price increases to offset the commodity inflation and the supply chain disruptions. But I think what speaks volumes about the strength of our portfolio and the quality of our products and the value proposition that we offer is that despite the price increases that we've had to take to pass on some of the cost increases, we continue to gain market share, we continue to grow volume. And frankly, if you look at the last 12 months, when the rest of the industry has been facing with volume declines as consumers return back to pre-pandemic consumption levels, we're one of the few players, if not the only one at this scale, that continues to grow volume, that continues to gain volume share as well as revenue share.
You were on a buying spree just a few years ago. Do you have any more acquisitions in mind?
We'll continue to look at M&A opportunities in all of our markets, both in terms of potential bolt-on acquisitions that would augment and complement our portfolio, as well as platform-type acquisitions that will help us accelerate the entry into those markets. So our teams are constantly looking at the inorganic options, and we look at how it fits with our overall strategy.
CJ Foods CEO Minsok Pak speaking exclusively to us in Seoul. And stay tuned for more on South Korea's cultural investments and also plans to attract 20 million foreign tourists this year. Our exclusive interview with Culture and Tourism Minister Yoo In-cheon coming up tomorrow, first here on the Asia Trade. This is Bloomberg.
Take a look at the morning calls ahead of the Asia trading day, and JP Morgan is downgrading China's stocks to neutral from overweight within EM Asia ex-Japan due to a challenging outlook. Strategists say equity risk premium is difficult to model due to global geopolitical tensions and domestic policies. The bank also sees more volatility in Chinese stocks as the US elections loom, with the impact of a potential tariff war 2.0 more significant than the first. UBS is ending a bullish call that it's held for 2 years on European tech darling ASML. Analysts downgraded the stock to hold from buy, warning the earnings growth potential from artificial intelligence is becoming overhyped. ASML shares surged more than 60% since UBS first implemented that buy rating in August 2022. The downgrade mirrors wider market misgivings that AI mania has gone too far. One stock that we are continuing to watch is Star Entertainment here in Australia. They're examining its liquidity situation before a key verdict is due on its beleaguered Sydney casino. They're reviewing their financial and liquidity positioning with advisors. Really, the future of this company is still hanging in the balance after an inquiry last week found it unfit to operate.
This is the Asia Trade. We're counting down to Asia's major market opens after another volatile session on Wall Street. It was really especially volatile, Haidi, when it came to the Treasury yield curve, at one point disinverting, job openings falling to the lowest level since 2021.
Of course, setting up for the potentially volatile reaction to non-farm payrolls. And as one of our contributors, John Authers, said earlier, wake me up when September is over, right? But then, of course, we're headed straight into the US election. So much for investors and markets to be contending with right now.
Yeah, especially with the Japanese yen also continuing to strengthen. Of course, we had Treasury yields falling, the dollar a little bit under pressure on the other side of the trade. We had the Japanese yen spiking, but then this morning, just half an hour ago, we also got real wages now growing for a second consecutive month, perhaps really giving ammunition to the Bank of Japan for another rate hike. So we have the Japanese yen now below that 144 level against the US dollar, heading towards 143. We're also watching JGB yields because they had already fallen under pressure because of weak U.S. manufacturing data. We're still under that 0.9% level. In the stock space, we continue to see downside after the worst day since the August 5th meltdown. And of course, one stock that we'll be watching for today, Nippon Steel, given that overnight we heard from sources that the Biden administration was looking into potentially blocking Nippon Steel's takeover of U.S. Steel, which overnight had the worst worst day since 2017. Take a look at how the Kospi is coming online as well. That was another market that was pressured. Of course, chip makers, a big story right now, given what's happening with Nvidia, really extending that sell-off. We're seeing a little bit more upside when it comes to the Korean equity market, but the Korean won holding at that 1335 level after we saw GDP data, Haidi, just reinforcing that the economy did shrink a little bit, quarter-on-quarter, 0.2%, but of course that was pretty much as expected.
I'll take a look, Shery, when it comes to the start of trading. Of course, that staggered session just coming online here in Australia. We're seeing the Aussie dollar a little bit on the back foot, 67.16 is where we're trading at the moment. A little bit of upside for the start to trading when it comes to equities. We are still pretty close to record highs when it comes to Australian stocks, and this comes after we saw the biggest slide since the August sell-off. So really tracking the risk-off session that we had across most of Asia yesterday. It was down almost 2%, so we're seeing maybe a little bit of a recovery in the early parts of this session. Pretty broad declines too, but of course we'll continue to watch mining shares. Iron ore is still pretty close to, it's above $90 at the moment, but some of those sort of evergreen China woes continue to play out as a broader theme, particularly as we see oil trading near those December lows as well. Let's get a closer look at sort of how much volatility we should continue to brace for. Martin Lakos is the Division Director at Macquarie Wealth Management and joins us here in Sydney. Martin, really great to have you with us. So
Thank you.
You're sort of tactically cautious. Is that tactically cautious until basically the end of the year or until we're past November?
Probably November is the biggest issue, probably for markets outside of, to some extent, valuations. Clearly, markets are to some extent priced to perfection, recent all-time highs once again. So it's not a surprise that we can see some additional volatility. And we've certainly noticed tactically that the market is getting a lot more sensitive to data points. In particular, obviously, this Friday is going to be interesting in the US non-farm payrolls. So that gives us some sense that there's probably some risk to the downside, but we're not looking for a major correction. Clearly, there's plenty of liquidity out there. We're obviously ahead of potentially a rate cut by the Federal Reserve this month. Macquarie is forecasting another cut in November and again in December. So there's going to be some relief from the high levels of interest rates in the US. And so as a result of which, we think the downside is limited, but yes, volatility is definitely going to pick up.
How do you feel about AI at the moment? Because there is this consensus that perhaps we need to see more on the demand for services side to justify the enormous amount of investment that we've seen so far.
So short term, you'd have to say is run really hard, right? Yeah. And we're now starting to see the market broaden out. So more and more players are coming into the marketplace, which is really quite interesting. But what's the time frame by which businesses, small to medium enterprises and large business, actually catch up in using the new technology that's flowing through? And sometimes you do have a bit of a gap in that respect, and you often see that potentially in revenue and revenue growth. Not that Nvidia's numbers were terrible, they weren't, but they didn't meet expectations. Maybe the market was overpricing that. But in broad terms, strategically, we've got to have exposure to the chip makers and the whole AI dynamic. So it is the new paradigm, but you've got to be looking at the time frames by which you have exposures.
Are they forever stocks, the way that your Apples and your Microsofts might be?
Yeah, well, you'd have to think that AI is now slotting into what we refer to as the tech utilities. So you've got to have a search engine. You've got to have exposure to the cloud. A Microsoft, for example, and the AI is exactly the same. So that definitely starts to slot into that perspective as well. But again, we've got to look at valuation, the take up of the technology, and typically SMEs are much slower. They're very focused day to day on their businesses and don't necessarily take a step back and have a look at what they should be doing from an investment perspective. So sometimes there's that lag.
If you want to be uncorrelated at the moment, what would you look at? I mean, I guess China has been outperforming relatively.
So we've certainly been upgrading our total asset allocation exposures in alternative assets and in particular infrastructure as well. So very much those long duration type of assets, and that's strategically where we're pretty positive, in fact very positive about. And they typically are 3 to 5 year minimum type of timeframes. And our client base is definitely very, very open to looking looking at the high quality, sound returns where they're very well analysed, and having greater exposures, so reducing market exposure. And typically those sorts of asset classes have low or no correlation to the volatility in markets. And I think, again, having seen where we are near all-time highs, the time is certainly right for investors to be focusing in on that. And that's certainly strategically a key focus for us.
And still a lot of keenness on private credit now.
Well, certainly there's been obviously a big shift. We've already seen a big move in sovereign debt. We're still very positive about sovereign debt over the next 12 months, given the potential scope of interest rate moves, particularly out of the US, less so in Australia at this point in time. But definitely when you've got attractive yields, 8-10% in private credit, again, investors are attracted to that because that's just not going to last forever.
What are the positives for China right now? Would you want sort of some indirect exposure?
Indirect exposure is probably the way to go. At this stage, we don't have direct exposure into China. I think there's just still too many moving parts for us. What we really want to see is more action by the authorities in terms of stimulus. Clearly, there are parts of China that's doing quite well. On the export side, particularly the energy transition exports are doing very, very well, but it's probably not a broad enough manufacturing uplift for us at this point in time. And then the consumer is extremely weak at this point in time. So we're cautious in that respect. Having said that, it does appear that the authorities are prepared to support 5% growth for the Chinese economy, and that's clearly good news. If we do start to see rates coming off in the US, we'd expect to see some US dollar weakness. That's probably good for the Chinese currency, and it may also help or assist Chinese capital outflows as well. So there's a few things emerging that we're starting to think about, but we haven't yet seen enough activity by the authorities to really be more convinced that the upward momentum, in particular upward momentum in Chinese company earnings, is there yet. But it's something we're watching really closely.
How closely are you watching the US election? We were just talking earlier about the,
is there a US election going on?
Have we spoken about this before? Yeah. There's not much in it when it comes to what the polls are showing at the moment, and regardless, polls have obviously led us astray previously. Are you sitting back before you make kind of any big sort of thematic assumptions about what could happen?
I think you've got to approach the US elections from an investor perspective with caution. It may well be that that's too cautious. At the moment, it's probably a binary outcome. It's 50-50. Either candidate really looks like they could have the presidency, given the polls, given what the US punters, where the money's going. At the moment, it's slightly in favour of Kamala Harris. But I think next week's debate is really, really important, particularly for both candidates to be thinking about policy and what they're going to be doing as against what's been going on in their background more recently. So, yes, it's very important, clearly, for the investment markets. At this point in time, we have an expectation of more volatility getting closer to the election, as it appears to be so close. I guess from an outcome perspective, I guess to some extent we'd like to see a clear winner. We'd like to see an acceptance of the result. And certainly, probably for markets, we'd probably like to see a split in Congress and the Senate. So not a clear win for any one party or any one candidate. And that will keep the checks and balances in place. And we think that would be more helpful from an investment perspective than having either party or either candidate having a complete, a very strong mandate, which would allow them to maybe bring in some of those policies that are probably maybe considered a little unfavourable.
Martin, always great to have you with us. Martin Lakos, Division Director at Macquarie Wealth Management. Shery.
Yeah, Heidi, we continue to watch really sovereign bond yields across Asia right now because we continue to see the pressure, especially in Japanese assets. The 10-year yield had already fallen below that 0.9% level after we got the weak U.S. manufacturing data yesterday. And remember, just about half an hour ago, we also got Japan's real wages rising for a second month. So you have sort of that divergence play again, right? Will the BOJ hike rates? And obviously, overnight, we also had the U.S. job opening numbers declining to the lowest level since January 2021, which led to a lot of volatility in the Treasury space. U.S. yield curve in the 2-year, 10-year disinverting briefly. Are we going to see a recession? And of course, volatility also rising to the highest level since 2023. And I'm not even done. We had lots of corporate bond sales this week. 81 deals in 48 hours. So watch out for the debt space this week. More ahead on the Asia trade. This is Bloomberg. We're following chip makers across Asia, with Nvidia having extended its two-day sell-off to 11%. A little bit of a mixed picture, with Korean chip makers gaining ground, leading the broader Kospi and the Kosdaq higher. You have Japanese chip makers under pressure, together with the broader index, with the Nikkei continuing to extend its sell-off after the worst day since the August 5th meltdown. Of course, we heard overnight also that Nvidia responded, saying that it's not been subpoenaed by the DOJ. Of course, we had the Bloomberg News report that the U.S. Department of Justice had sent out subpoenas as part of an antitrust probe. For more on Nvidia, our tech reporter Annabelle Jewelers joins us now from Taipei. Belle, what exactly did they say?
Well, Nvidia was responding to this Bloomberg exclusive, where essentially we had been reporting that they had been subpoenaed by the DOJ and as well as other businesses and compelled legally to provide information on whether they were having any sort of exclusivity and a monopoly around its AI chips. So that was the Bloomberg exclusive report. The response from Nvidia was that essentially the reason why they have so much clout in the market is because of its merit. They're saying that their chips are just such high quality, and that's why they have such a strong customer base and such a strong order backlog. So that's the response from Nvidia. Of course, it doesn't mean that scrutiny from them on regulators or by regulators is going away anytime soon, because there is concern that Nvidia has made it more difficult for customers to switch to AI chips. There's still a lot of uncertainty around where the stock trades from here. $100 a stock is seen as sort of the base case for now, or bottom line in the sand.
What was... Yeah, Bill, I do wonder what was the sort of sentiment and confidence that you heard speaking to people at Taiwan Semicon yesterday?
Well, it's been quite a different story here across the week, really, in Taiwan so far. But Semicon yesterday, really the main message that came through is that we're really still in the very early innings of the AI race. And we still haven't discovered, for instance, a lot of different applications that's going to continue to drive demand. I did actually speak with the CEO of Signtech. This is a major supplier to TSMC, and they've had a very strong performance in share price this year alone. It does work in the advanced packaging space, but here's my conversation with the CEO. Take a listen.
We are lucky in this AI industry. We benefit from the equipment that we build, the process that we develop with customers together to enable AI process. So that's why our investors value Signtech as a potential company who can really contribute in this industry.
And what sort of demand are you seeing? What's your outlook for demand for your equipment toward the end of this year, but next year as well?
The growth will be substantial for next few years. The growth rate will be much, much higher than 8%.
Can you give the number?
The equipment that we sold to them probably increase 2 or 3 times a year. It is possible. And so it is also benefit Signtech from their revenue.
Do you see any risks to that outlook?
From my personal perspective, this booming of AI industry just begin. There's a lot of application I do expect will coming out pretty soon. So that's why Jensen Huang, some time ago, he said the overall market of AI will reach 100 trillion at some point in the next probably few years.
We're seeing a lot of Taiwanese companies that are choosing to expand abroad. Do you see any sort of concentration risk from choosing to focus your attentions here?
Of course. Definitely, we will try to, evaluate alternative locations, either for the R&D, for the manufacturing. Internally, this is under our processing.
Speaking more broadly now, what has been really capturing a lot of attention in the chip equipment manufacturer space or chip equipment provider space is the measures that we're seeing applied on Tokyo Electron and ASML and restricting sales of certain equipment to mainland China. That risk of tariffs or being prevented from selling to the Chinese market, is that something that concerns you or Scientech as a business?
My direct answer to you is no, because the equipment that we built are mainly for packaging applications, and the packaging applications is not included in this limitation.
Do you see that risk ever appearing in the future? Is it something that you're looking at closely?
We all know the advanced packaging is becoming more critical every day. Most likely it will happen, but who knows?
Scientech CEO Minsok Pak there speaking to our tech reporter Annabelle Jewellers. More ahead on the Asia trade. This is Bloomberg. Taking a look at how commodities are tracking, we're seeing a little bit of stabilisation, particularly when it comes to the iron ore price. Still, we're pretty close to that $90 level. Trading in Singapore, just about short of $93 at the moment. And this, of course, as we see, really not much of a sign of improvement when it comes to Chinese steel mills, when it comes to weak demand and falling profitability. Iron ore prices pretty close to the lowest since about 2002 still at this point. Also watching copper at this stage, we're seeing a little bit of upside, about 0.3%, really more of a stabilisation. We have seen copper trading to about a 2-week low as well, again, by the increasingly dim outlook for the recovery in demand out of China as well. Watching crude, we're sort of not seeing much of an impact when it comes to the potential for OPEC Plus to delay that move to increase oil supply. But at the moment, Brent is holding at just under $73 a barrel. Bloomberg Intelligence sees the recent rebound in the dollar adding to pressure on metals prices. Michelle Leung leads BI's Asia Metals and Mining Research and joins us now for more. So we've seen the sort of volatility in iron ore really quite high over the past few months, and a lot of it is to do with China. But what's the broader sort of price outlook from here?
Yes, we did see a rally in April, but actually I think that's mainly because of the market's hope that the government, the Chinese government, will push out more favorable policies to support the steel industry. However, fundamentally, it's still pretty bad. We see that the steel mills are still making massive losses, and recently we see more production cuts coming in, starting from July. So combined with the slowdown in the construction industry as well, it all doesn't give a very positive picture on the demand side. And on the supply side, we also see a new wave of new supply coming in, which is from the West Africa. We see that the Simandou project, which has a lower than average industry cost for production side, will come in next year, expecting at least 5 million tons of production. And it will soon ramp up to as much as 90 million tons by 2028, and then 120 million tons in the long term. So certainly on the demand side, it's very hard to catch up with that pace.
And there's, of course, also how the strength of the U.S. dollar could factor in. You have new research on this. What are the key findings?
Yes, recently we published a report talking about the correlation between the metal prices and U.S. dollar. In our research, we find that aluminum, nickel, and gold price actually have the highest inverse correlation between the commodity price and the U.S. dollar. Say, for example, when the U.S. dollar strengthens, these commodity prices likely to be under pressure. And we also find that actually the production correction size from the company have led to influence on the correlation between their share price and the commodity price, except aluminum. We see charcoal and Hongqiao, which are the two largest aluminum producers in the world, their correlation between their share price and the aluminum price have actually the highest correlation. But talking about the fundamental aluminum, we see that on the it should be benefiting from the limited new supply. However, on the demand side, in the second half especially, it has been clouded by the sluggish EV growth or construction as well as solar growth. But we also see that the prices might have limited downside as it's already touching the floor price at around 18,500 to 19,000 yuan per ton.
Michelle Leung, who leads Bloomberg Intelligence Asia Metals Mining and Sustainability Research. Great to have you with us, of course, with the volatility in metals prices, commodities prices. We've been watching those stocks, but this one, Nippon Steel, a whole different story unfolding around this company. We're seeing it really retrace some of those earlier losses in the session, and after 3 sessions of losses, President Biden is said to be preparing to block Nippon Steel's $14 billion takeover of U.S. Steel. Sources say a decision could come as soon as this week. For more, let's bring in Managing Editor for Commodities and Energy in Asia, Clara Ferreira Marquez. And Clara, of course, it's an election year in the U.S.
Absolutely, and I think Nippon Steel is very, very much aware of that now. So where we are now is that we're expecting a CFIUS decision imminently to be transferred to President Biden, who will then block the deal. That could come as early as this week. The question is, what happens next? This, in many ways, is a foregone conclusion. What we need to know now is whether a legal recourse will have any impact. There's very, very little evidence that it would, but it seems from the language that we're getting from both US Steel and Nippon Steel that that is likely. The next question is whether anyone else would come in for US Steel. US Steel shares dropped very sharply yesterday, as much as a quarter, losing as much of a quarter of their value. So we have companies like Cleveland-Cliffs certainly standing in the wings.
You mentioned some of the legal sort of remedies, right? If we do get to litigation, is there sort of any hope, given that we've now heard what the president wants?
I would say it's very limited. I mean, there are very few cases, in fact, and struggle to think of any where legal recourse has had a successful outcome, and particularly considering where we are in an election year. And then, of course, the question marks over what happens in November and who comes in after President Biden. I think Vice President Harris has made her position very clear as well. So I think there is almost a bipartisan view on this. For Japan, of course, we're also waiting to see what the diplomatic response will be.
Managing Editor for Commodities in Asia, Clara Ferreira Marquez. More ahead on the Asia trade. This is Bloomberg.
When it comes to the consumer, what we continue to see is a somewhat steady consumer.
Over the last year, things have settled out, but they haven't in any way pulled back in a meaningful manner.
Asia is the fastest growing market, including China, Japan, Australia.
China's a fantastic market.
Not much has changed with the consumer over the last 6 months. They're employed, wages are growing, but they are being choiceful.
In terms of a major pullback, no, we haven't really seen that yet.
Analysts and executives speaking to us at the Goldman Sachs Retail Conference in New York. Take a look at trading across Asia. A little bit of a mixed picture because we're seeing the Nikkei being pressured by those semiconductor names, down 0.4%. This, of course, after seeing the worst day since August already, since August 5th, the meltdown that we had earlier in the month, and as we get real wages rising for a second month as well. The Kospi, though, being supported especially by the likes of SK Hynix, by the likes of Samsung as well, gaining ground despite the fact that we saw Nvidia extending the sell-off overnight. The ASX 200 also gaining about 0.5%, Heidi.
Yeah, and we're watching our geopolitics so closely at this time of year, right? President Xi Jinping set to lay out his blueprint for growing China's relationship with Africa as debt criticisms and a slowing economy limit his country's lending power. Our chief North Asia correspondent Stephen Angle joins us now from Beijing. And Steve, we spoke a little bit yesterday about the changing sort of dynamics of this debt relationship and China's soft and investment power across Africa. What are we expecting from these meetings?
Well, we're going to get the big keynote speech, the opening speech from President Xi Jinping later this morning at the Great Hall of the People. We're here at the National Convention Center where all the delegates and the leaders from some 50 African nations will all take the buses or limousines back across town to here for afternoon sessions and that continue through tomorrow as well. So again, he's going to be talking up what has been pretty much a signature plan and project of Xi Jinping, and that is investing in and getting natural resources and energy out of those deals from Africa. And it is something, despite what some have alleged to be debt traps, and yes, many of these African nations are in debt distress or even default. Zambia, Ghana, and I think it is Ethiopia have already defaulted. More than a dozen are already nearing debt distress, not all because of the loans from China, but again, the pandemic really hit cash flows and performance, and the rising interest rates and the king dollar also created kind of a perfect storm for the fiscal situations in Africa. So they need China, but again, China is going to be a little bit more restrained on its lending through the Belt and Road Initiative. It's not going to be the heady numbers that we saw like in 2016 when there was $28.8 billion worth of mostly state-backed bank loans to African nations. It was just $4.8 billion in the first year coming out of the pandemic last year. So it's going to be a little bit more restrained. So it'll be interesting to hear what Xi Jinping's tone will be. That's on the fiscal and economic side. Geopolitically, these two blocks, China and the African continent, have really been intertwined diplomatically. The United States, Europe, and China all courting the so-called global south, a rising influential bloc, supposedly non-aligned, but essentially they're going to be much more influential in the UN, in global trade discussions. It's one estimate that I've read is that essentially a fourth, at least a quarter of the global population will come out of Africa by 2050. So it is a rising influential base geopolitically and, of course, going to be economically, according to China.
And Steve, you've already had some meaningful conversations with African leaders. What was top of mind for them?
Well, I did speak yesterday, and we'll hear from it in just a minute, the foreign minister of Djibouti. Obviously, Djibouti right there on the Red Sea and the Gulf of Aden, strategically located, but also in between a very political hotspot. You have oil tankers burning off the coast in the Red Sea because of those Houthi rebel attacks. You have Eritrea having difficulties to the west with Ethiopia. You have, of course, Somaliland, a breakout, independent or a semi-autonomous nation to the east that is, of course, in dispute with Somalia. There's lots of geopolitical hotspots in the Horn of Africa. But what has brought stability, according to the foreign minister of Djibouti, has been increasing ties with China. This is what he had to say.
We know that today, China has maybe not the same capacity, despite the fact that the willingness is there. We are living in a polarized world. There is something coming in the international arena. The African Union is trying to position itself. Now, we will certainly adapt to the new conditions that we are faced with. African countries have each one specific needs, specific expectations, but the priority should be to focus on strategic partnerships. When it comes to peace and security, we have an African architecture for peace and stability. We expect from China that China will support that architecture, specifically the Peace Fund. We also expect that China will step up in its support financially for the modernization of the plan that Africans set for themselves in terms of agriculture and so on and so forth. I think this is a two-way partnership. Of course, we know that China expects also a lot from the African continent.
They want more, better returns. Obviously, they've gotten minerals and they've gotten energy through their partnerships, through their 120 billion plus that they've invested through state policy loans. Yes. But they also want returns. So are you finding perhaps for African nations, the wallet is a little slimmer and it's not opening as wide as years past?
I'm not saying that the partnership is a balanced one. But we have to also recognize the fact that China is now one of the biggest industrial products producing country. It needs market. It needs, partners on the African continent. It needs minerals and natural resources. China has a boiling economy. At the same time, we also feel that we can take our own advantage of that partnership when we speak as a united African countries.
And one of the issues also that was brought up earlier this week by the South African President Ramaphosa, and that is the trade imbalance between the African continent and China. Actually, China had a trade surplus of a record $64 billion last year. And essentially, China has been exporting its excess industrial capacity into places like the African continent. And that obviously does not necessarily help the fiscal positions of the debt-strapped countries in Africa. Guys?
Our Chief North Asia correspondent Stephen Engel, they're joining us live from the summit in Beijing. Let's bring in our next guest. Joshua Eisenman is a professor of politics at the University of Notre Dame, where he focuses on China and Africa's relation. Great to have you with us. As we continue to see, as Steve just told us, rising concerns and also criticism about the so-called debt trap from China. Where do you see this relationship going and what this conference can do?
Well, it's great to be here. Thanks for having me. I mean, I think the first thing we have to do is step back and recognize from the 50,000-foot level, this is a really important conference. It's one of the first big conferences that China is holding out of COVID. And the last FOCAC conference held in Senegal was almost an entirely online affair. So now we've got 53 African heads of state in China meeting with Xi Jinping. And, under this banner of the Community of Shared Future, that's the name of the conference, the Building a High-Level China-Africa Community with the Shared Future, in many ways set up in juxtaposition to what we in the West call the rules-based order. So from a kind of a larger perspective, what China is trying to do here is suggest that it offers an alternative world order that countries in the Global South and African countries can gain from. And the question is that necessarily the case? Based on the package you've just put forward, I think that's a question right now. And so China's trying to kind of address some of those questions that it's put out there, particularly as it's looking itself for markets, and Africans are looking to deal with this trade deficit issue, as well as loan issues, which, as you mentioned, are particularly problematic. But we shouldn't forget that they're also problematic on the Chinese side. Having lent so much money, China now has to at least recoup some of it. And so there are really pressures on both sides of the relationship.
Yeah, so how much progress has Beijing, in fact, made when it comes to not only purely commercial relationships with African leaders, but also just the ideological leadership of the Global South? And how much progress has it made in propagating that idea?
Well, I think quite a bit, actually. I mean, China has really prioritized Africa in a political sense, which is they have a large amount of effort to cultivate what they call people-to-people relations, whether that be educational relationships, whether that be on the diplomatic side or party-to-party relations, which they really put a lot of effort into the Communist Party of China's efforts to engage African political parties. So they really do put a lot of emphasis, and you can see it through this conference, that they're really trying to build build out the political relationship. And on the military side as well, China has arms sales to Africa. China's helping African countries launch satellites. And there's a variety of cooperative engagements on the political side, which really help to lend credibility to China's approach, because while the West, especially the United States, does not prioritize Africa, China goes out of its way to do so, including the first trip every year being from the foreign minister. So these are powerful signals. And when you send them to a region which has been dejected by the West for a long time, they can be quite effective. In many ways, China is trying to cultivate this global sufferers club with itself as the kind of leader of that club. And a lot of these comments actually are received quite well, because, you're dealing with Africa, a continent where the fathers and sometimes the leaders themselves actually have an experience with colonialism. It's not all that far in the past. And so China's approach to saying, hey, we're offering something different, this community, I think it does have some resonance on the continent. But the question is, I think at this point, given the challenges we're seeing on the economic side, the sustainability question of whether or not China can really continue to lend money to a continent that is really, in many cases, kind of full up with loans. And then the question of whether China is going to open its markets more to African goods. I think this just remains an issue.
Right. Yeah, Joshua, I do wonder how appealing, how attractive that ideological overture is if it doesn't go hand in hand with the continued sort of amount of largesse when it comes to debt, right? If China doesn't, if Beijing doesn't shift its positioning on debt refinancing, for example, or debt forgiveness, do you think that relationship could cool?
I mean, I think that's a major issue right now. And, right now the discussion is about smart and beautiful projects, right? Which basically means less money for more projects. But the problem has always been an issue of due diligence. It's hard to do due diligence even under the best of circumstances. We shouldn't forget the Chinese economy itself is facing massive local deficits, in the trillions that far outstrip anything from the Belt and Road. So one could argue, if they haven't done it well at home, would they necessarily do a good job in Africa and other places? And arguably they haven't. And now the question is, what comes next, right? You obviously cannot continue to lend money the way they have. China just this year finally ticked up its lending to Africa for the first time since 2016. So the question is, what comes next here? And I do agree with you. I'm not sure that you can have a robust political relationship if the economic relationship is fundamentally unbalanced, especially these trade deficits. And, we in the West are used to trade deficits, but when you look at a country like Kenya, Ethiopia, you're looking at 90, 95, 96% of trade coming from China. And that kind of trade deficit isn't even anything we experience in the West. So I think these problems on the economic side will continue.
Well, that's the thing, right? If the criticism would be that if you take a look at the trade relationship, the exporting of not just goods but also services and manufacturing jobs, how does that differ to the criticism, as you say, of that colonial past?
I mean, I think this is a really potent point, right? For many years, we've been hearing that China's going to move production to Africa, that it's going to create special economic zones, and that production is going to shift to these kind of low-cost producers. But that really isn't what we've seen, and I don't think it's what we're going to see for a variety of reasons. One, because wage levels are not the only driver, right? You need a consistent source of electricity. You need to have ports. You need to have a whole infrastructure established. And China has really created an amazing infrastructure for manufacturing. So it's hard to imagine large-scale manufacturing moving to Africa. So if China wants to sell its EVs and other environmentally friendly goods, which are being locked out of the European, American markets, well, then it has to look to places like Africa. And the question is, how much more bandwidth does Africa have to consume more Chinese products when they themselves would prefer to export more product to China? So I think there really is a kind of tension here as China's looking to unload this excess capacity, especially in environmental goods, solar panels, things that we have tariffs on in the United States. Where are those things going to go? And I think the question is, can they go to Africa? And it seems to a limited degree. That being said, China has done a great job in the cell phone market, even in terms of social media. They've paid a lot more attention to the African consumer than Western companies have done. So I think it's a mixed bag.
Joshua Eisenman, really great to have you with us. He's a professor of politics at the University of Notre Dame. Coming up next, our exclusive interview with one of South Korea's biggest food companies, the CJ Foods CEO, on how they're expanding the global reach of Korean dumplings, kimchi, and more. This is Bloomberg.
We're seeing gains in South Korean assets today after the worst sell-off since the August 5th meltdown, especially in the likes of SK Hynix, which is gaining more than 3%. Remember, they lost more than 11% in the past two trading sessions, really mirroring its customer Nvidia. Right now, we're seeing Samsung also leading those gains. We have seen, of course, second quarter GDP numbers coming in as expected, shrinking 0.2%. But when it comes to the BOK's latest full-year forecast, we're still well above the projection provided at the start of the year. So we're seeing resilience in the Korean economy and the rising popularity of South Korea's entertainment exports, also potentially giving its homegrown food brands a massive new platform to reach global consumers. Industry giant CJ Cheiljedang is aiming to double its business within the next decade. CEO Minsok Pak spoke to us exclusively in Seoul about their global strategy.
And we've prioritized all the different countries and markets, and we have a list of the markets where we want to enter. And for us, Europe is an emerging market, as an example. Everyone else thinks about Southeast Asia or Latin America, but for me, Europe. Europe is a huge market opportunity for us, and it's one where we've been in Europe for a few years now, and we're growing 50% plus a year. And so there's a huge opportunity for us there. Korea has to stay as an anchor, really driving the innovation and our capabilities, but future growth really will come from outside of Korea.
Where does China fall into that mix of regions?
In Asia, China is an important market for us. It's a huge consumer market, particularly in food, and we have a very vibrant business there. We have local manufacturing, we have business in sauce, we have business in dumplings. We have some really exciting innovations that we actually launched in China last year with our new pasta lines there. So China is an important market for us, and I see definitely future growth opportunity in China.
When we talk about China, we tend to focus on the slowing economy, domestic demand being weak. Does that affect your business?
It does to a certain extent, right? Anytime when you have slowing domestic consumption, obviously as a packaged food player, it does impact you. But we happen to be in categories where household penetration is still relatively low, and there's a lot of excitement for the products and for the categories, and so we'll continue to grow that way.
When it comes to consumers, it's all about inflation as well and food costs rising. How is that affecting your business model?
I think it's impacted us just like it has all other food players. The commodity inflation in everything from grains to meats, the supply chain disruptions that happened in the last 24 months. It impacted us like it did everybody else. And so in many of our markets, we did have to take price increases to offset the commodity inflation and the supply chain disruptions. But I think what speaks volumes about the strength of our portfolio and the quality of our products and the value proposition that we offer is that despite the price increases that we've had to take to pass on some of the cost increases, we continue to gain market share, we continue to grow volume. And frankly, if you look at the last 12 months, when the rest of the industry has been facing with volume declines as consumers return back to pre-pandemic consumption levels, we're one of the few players, if not the only one at this scale, that continues to grow volume, that continues to gain volume share as well as revenue share.
You were on a buying spree just a few years ago. Do you have any more acquisitions in mind?
We'll continue to look at M&A opportunities in all of our markets, both in terms of potential bolt-on acquisitions that would augment and complement our portfolio, as well as platform-type acquisitions that will help us accelerate the entry into those markets. So our teams are constantly looking at the inorganic options, and we look at how it fits with our overall strategy.
CJ Foods CEO Minsok Pak speaking exclusively to us in Seoul. And stay tuned for more to come on South Korea's cultural investments and plans to attract 20 million foreign tourists this year. Our exclusive interview with Culture and Tourism Minister Yoo In-cheon coming up tomorrow, first here on the Asia Trade. Heidi.
Let's take a look at some of the headlines we're tracking on the corporate front. Shery, Blackstone has agreed to buy AirTrunk in a deal valuing the Australian data centre operator at about $16 billion. The deal also includes debt and capital spending for committed projects. If approved, it would be Blackstone's biggest ever investment in the Asia Pacific and one of the biggest global deals this year in digital infrastructure. Alimentation Couche-Tard says the weaker US economy may improve the prospects for making a large acquisition. That statement was released alongside the Canadian convenience store operator's first fiscal quarter earnings results. Couche-Tard's news release made no reference to its interest in Seven & i Holdings, but an agreement for Seven & i would be the biggest foreign takeover ever of a Japanese company. HPE shares fell in extended trading after the company reported weaker than expected margins. Its adjusted gross margins stood at nearly 32% in the fiscal third quarter, marking a decline from a year ago. This suggests a lower than anticipated profitability in its closely watched AI server business. More ahead on the Asia Trade, this is Bloomberg. Take a look at one market fall that we're following today, and JP Morgan is downgrading China stocks to neutral from overweight within EM Asia ex-Japan due to a challenging outlook. And strategists say equity risk premium is difficult to model due to global geopolitical tensions and domestic policies. The bank also sees more volatility in Chinese stocks as the US elections loom, with the impact of a potential tariff war 2.0 more significant than the first. Let's take a look at how we're shaping up when it comes to futures that are trading at the moment as we head into the start of trading in Greater China. On that downgrade, we are seeing FTSE 50 China futures off by just about 0.1%. We're seeing at the moment weakness in particular when it comes to Japanese stocks with the yen gains. The steady in the dollar, though, being seen at the moment, but that 143 level seeing some downside for equities there. S&P futures as well as TAIEX futures looking a little bit more optimistic. This is Bloomberg.